Recording in progress. Good morning, everyone. Welcome to this webinar brought to you by Bursa Malaysia in partnership with RHB Investment Bank. So today's webinar's title is RHB Global Economics and Market Strategy, Sunshine Coming Despite Challenges Ahead. So thank you so much for tuning into this webinar in the early mornings. So we know that you take time out of your busy schedule to be with us in this session. So we'll do whatever we can to make it well worth the time in this morning. So before we begin, I just want to do a shout out for those of you who are not yet a RHB client. And if you wish to sign up an account with RHB, then for this session only, hang on, yeah, my freeze. For this session only, RHB is going to waive the CDS account opening fee. So what you need to do is to, during the course of this webinar, you just type in the Q&A box, leave us with 3 details, which is your name, your phone number, and your town and a city. Then RHB Investment Bank will arrange a friendly dealer representative to attend to your needs to open a trading account. Okay, and if you participate in this session, if you open a trading account in this session, then you will get your CDS account opening fee waived by RHB. So on top of that, if your first 100 women investors who open a CDS account with RHB during the campaign period from 11 November 2021 to next year, January 31st, then you'll be entitled to a 50 ringgit touch and go e-wallet reload pin. This is sponsored by Bursa Malaysia. So these are our promotions for today. And for those of you who have not joined RHB Telegram channel, you may head over to scan this QR code on your screen right now. You may join RHB Retail Equities Malaysia Telegram channel for exclusive research insights, events, contests, and many more things. All right. So yes, today our topic here is RHB Global Economics and Market Strategy, Sunshine Coming Despite Challenges Ahead. We have invited the Group Chief Economist, Dr. Silas, to share with you the outlook in 2022. Okay, RHB advocate accumulating risky asset in particular geographies. So today we're going to hear from Dr. Silas. Okay, so first and foremost, let me briefly introduce Dr. Silas' background. So Dr. Silas is a seasoned market strategist and economist with over 20 years of experience covering global and Asian markets across most asset classes. So prior to joining RHB, he was Chief Asia Economist at Credit Suisse Group, Singapore, with a focus on China, India, and Southeast Asia, and also provided inputs on global macroeconomic and financial markets developments. Dr. Silas Jha has held various senior positions in global investment banks, including Credit Suisse Investment Bank, Barclays Capital, and Jefferies Group. He has also served as an economist at the Asian Development Bank and as a consultant for the World Bank. So Dr. Silas is a permanent invitee of RHB Group ESG Capital Market Advisory Council. He also leads RHB research effort on ESG themes to educate investors on ESG investment and trends. Dr. Silas has been a highly ranked analyst by Institutional Investors Survey, Eleonora Survey of Global Fixed Income Investors, and the Asset Magazine. So that's a brief background about Dr. Silas. So without further ado, let me invite Dr. Silas to come to this webinar. Good morning, Dr. Silas. How are you?
Yeah, hi, morning, Shane. Hope everybody is well. May I share my screen, please, for the presentation?
Sure. Okay. You may go ahead and share your screen.
Okay. Can you let me in?
Yes, I have.
Oh, okay, good.
You can share.
Got it. This is the most difficult part. We couldn't do the virtual background. Sorry, clients. But hopefully you can see the screen. Here's my screen sharing. Perfect. Okay. And let me just scroll down in the interest of avoiding any technical issues. Can you see the scrolling?
Yes. Perfect.
Excellent. Excellent. All right. So that's the hardest part of my presentation, everybody. So good morning. You know, it's a sunny Saturday morning here in your beautiful country, Malaysia. This is my first posting here. I'm a global expatriate. I'm very fortunate to be based here with you here in Kuala Lumpur and with RHB Group. So, coming into the last 2 weeks, as all of you know, there's a wall of worry in markets. We've had basically over the course of the last 2 weeks, sell down in the equity market. We've had essentially the dollar strengthening big time. We've had, bond yields in the United States declining, and there's a certain sense of fear and unease in markets. The wall of worry essentially pertains to, and this will continue, we think, probably over the next several months as we head into the to the new year, is the new Omicron virus via the COVID-19 new variant. How is it going to impact the recovery of the world? And here in our home continent, Asia, Japan, we've seen this movie before, but markets do essentially react to such event risk. Markets are also fairly worried about inflation, where we've had basically inflation being contained so far in terms of elevated inflation in the United States, Europe, and parts of emerging markets. But whether that's going to spread to the world, that's another worry. And on back of those inflation fears, markets are starting to price in fairly aggressive policy rate hikes by the biggest central bank and the most important central bank, if I may, of the world, which is the US Federal Reserve, short form, the Fed. What they're going to do, they're pricing in aggressive hikes. And the third is essentially what's going on in China. China slowing. Is it going to be a hard landing like what the fears in markets were back in the day in 2015? The basically Western governments putting a lot of pressure on China on a whole host of things on the economic front, in terms of geopolitical risks in Straits of Taiwan. You name it, we got it in terms of this wall of worry as we're heading into the new year. And hence, we stepped back and thought, okay, right, we have all these risk factors in play, but what do we do with all of this? At the end of the day, my job and our group's job is to essentially guide you as to what to do with your investments. And hence the title, again, because it's a bright Saturday morning, it's a great thing that it is a bright morning, because the title of this presentation is that the sun also rises despite challenges ahead. That's basically the key message. If you don't want to stay for the rest of this presentation, that's kind of all you need to know, because I guess you know where I'm coming from, in the sense that the bottom line is this bouts of weak market sentiment, it will happen. That's the only certainty that we can contend with, despite life being fairly uncertain. But these are all opportunities from our perspective to buy the dip. Right? This is, I hate to say this kind of words, you hear it every day on CNBC and Bloomberg, but that is what our main view is. Then the issue becomes, what dip do you buy? What exactly do you buy, right? And what do you avoid? That's the biggest question. So before we even get to that, in terms of, global asset allocation, in terms of, what are the things that are looking attractive, which are not looking attractive, we need to focus on what are the themes, the top-down macro themes, which will essentially drive financial markets during the course of 2022. The first is the Fed, right? What will they be doing in terms of a monetary policy? And our core view is that, unlike what the market is pricing in, that the Fed will hike aggressively starting in 2022, we think that the path of Fed hikes is going to be fairly gradual. So one less worry for you to contend with. The second big theme that is out there all over the world now, supply chain bottlenecks. not enough ships or not enough trucks to transport those goods. Where are we on that front? And so we basically have proprietary data of ascertaining where the supply chain bottlenecks are in the United States. The US is, again, the most important market in the world. So if those supply chain bottlenecks still exist it's going to cause problems for the rest of the world. And our core message is that the supply chain bottlenecks that are in the US, which are happening here already in Asia, in the Asian region, they're just going to get worse as we basically traverse 2022. They're not going to go again. They're not going to recede over the course of the next 12 months. The third is that the headlines that you see on China, those risks in terms of the financial markets, they're going to be with us also in 2022. But nevertheless, it seems like there's only one good news and two bad news. So you would think, hey, what's this guy talking about? How can you be so positive, right, on the world and markets? Well, I'll go through that in a bit. But from a global asset allocation perspective, we still advocate being overweight equities and alternative assets in our overweight, and market weight fixed income, and underweight cash. In terms of if you are an equity market investor, we think that the places to buy the dip are essentially the United States, India, and some parts of Southeast Asia like Indonesia, and you'll be happy to hear, but potentially Malaysia. In terms of markets that we don't like China. We also basically don't like markets or prefer less those markets which are correlated with the China market and business cycle. And those include places like Singapore. They include the North Asian markets, which are deeply connected to the financial markets of mainland China. If you're a bond investor, we think it's best to essentially, if you're holding in onto any longer term bonds, is essentially sell. The problem also is that as policymakers in this part of the world start hiking interest rates in the second half of the year, essentially you will also get short-term bonds being affected. So what in plain English, what will happen is the yields across the curve in terms of local government bonds will be going up. That's why we call that a bear flattening. The entire curve shifts up. So all you need to know as an investor is that rates are going up, whether you're looking at short-term interest rates or long-term interest rates. So if you haven't locked in, for example, in terms of your mortgage or other interest rate sensitive assets that you have, now is particularly still the time to do so. You have that opportunity. In foreign exchange, well, we have been dollar bulls for quite some time. Since December of 2020. We think this dollar strength against Asian currencies, including ringgit, will be there until around second quarter of next year. But then in the second half of the year, we should start seeing the dollar weaken against Asian currencies. So in home-based Malaysia, our year-end forecast for some time has been for 20 and for in the first quarter of next year at 430. And that's kind of going to be the path. And we've been fairly accurate on our forecast on dollar ringgit. And by the time we end 2022, we will be at around 415. So for those of you who have kids, studying overseas, or essentially you want to do some investing overseas, and it's, let's say, dollar denominated, then you would want to essentially go buy some dollars today for your immediate needs. If you don't have any immediate needs, over the course of the next 6 months, then fine, you hold on to your ringgit. So that's kind of the key messages. Let me work you through some of the details of our view. So until the 2nd of December, these are the total returns that you have gotten around the world. And this slide I show to all investors every single quarter that I do my marketing, whether it's to the retail investors or institutional investors and other investors. This slide is very important because you'll know exactly how assets around the world have performed. And what you can see is very clearly that the commodities are at the top. They have just outperformed all assets, right? Whether you look at the oil, whether you look at the London's metal exchange, that includes metals prices, obviously, and the US, and essentially, India, right? In terms of stock markets. So for me, when I think about my own personal investing, I always think about keep it very simple. As an anecdote told by a good friend of mine in Singapore, where I was based for around 16 years, he's a hedge fund manager. He said, hey, I run a hedge fund, but I've underperformed my mother, because what my mother did back in the day in 2010, as we were exiting the global financial crisis, she bought some S&P 500 ETF, which is up by what? Must be over 150% by now, right? And she's completely outperformed me, where I've done basically around 4 to 6% a year annual average since 2010. So if someone's a mother can outperform a hedge fund manager, that's saying something. It really means keep it simple. And in this context, we're keeping it simple for you, that the United States, in terms of if you're an equity market investor, the US, India, and basically commodities are going to continue to outperform in 2022. And we'll get to the reasoning in a bit. If you're thinking of being cute, and I don't mean to criticize anybody, and want to basically buy the dip in emerging markets, as you see some market participants advocating that the US stock market's looking expensive, emerging market looking cheap. Well, emerging markets are cheap for a reason, because there's very limited catalysts in EM to buy the dip. And that's why you notice, whether you look at Msci Korea, Korea is basically a very good destination in terms of picking up those tech stocks, isn't it? But nevertheless, Korea, MSCI down 10%, right? You look at essentially China is down 20%, Brazil is down 24%. So do you really want to basically dip your toes into those sorts of markets, which, yes, potentially places like China are looking cheap on a valuations basis, but the risk is cheap for a reason, because the risks are high. So you take your pick. You want to take a lot of risk, fine, you go and invest in EM. But if you want to be basically relatively less in terms of taking on risk and be able to sleep at night, US, China, US, India stock market, that's the place to be. And basically add some commodities as part of your investment portfolio in terms of alternatives, along with other assets in the alternative space. The thing that every day in the morning when I wake up, along with my esteemed colleague who's on the call, Eric Lee of Retail Brokerage Team, first thing I look at and on my Bloomberg screen is what's going on in the bond market. Because the concern right now really is where are long-term interest rates. For stock market investors, that's super important. Where are long-term interest rates going? And the left-hand side chart on slide 4 tells you there's no conviction. The left-hand side is just basically flows to US long-term bonds, which includes the US 10-year bonds, which are the anchor for global bond markets. You get that call correct? You're pretty okay on a directional basis, maybe not levels, but on a direction basis. There's no conviction. The flows are all over the place. Right now, as of 1st of December, you're seeing a huge inflow into US long-term government bonds, because people worried about growth, they're worried related to the the Omicron virus, how that's going to evolve, stagflation worries of sorts, and basically investors are buying U.S. long-term government bonds. And as a result, on the right-hand side, you're seeing the dip in the U.S. 10-year and stabilization in the Malaysian government securities 10-year. When I see things like this, I get worried that, there's no real conviction as to what the market wants to do in terms of U.S. long-term government bonds. So what that tells me is that basically the pace of the pickup in long-term bond yields in the U.S. will be fairly gradual. We're going to probably get to 2 to 2.1% only by summer of next year. We're currently trading, I didn't look at the screen this morning, but yesterday when I slept, it was trading around 1.45% to 1.47%, going to 2% around to the 55 basis point move over the course of the next 6 to 7 months is not a big deal. So again, not to worry, the trajectory of long-term yields in the US is going to be at a pace which is fairly gradual, and that gradual pace is not going to cause those dislocations in global financial markets, as many in the market would potentially have you believe. The worry, yes, this slide tells it all. All of a sudden now, unfortunately, so I was getting ready to go home to my home country, India, on the 10th of December, but because of the Omicron virus, I canceled my plan. Yeah, because you've seen the number of cases, places like Germany go up, you're starting to see the US go up. And I don't think I'm being sensational when I say that it's going to spread here. We're already getting cases over here in Asia, right? Malaysia, we have a case. Singapore, we have a case. India, I heard overnight, had a case. Korea has cases. Japan, everybody's going to get it, right? It's just the way it is because the international borders have been opening up over the course of the last several months. It's going to happen. I think we just need to prepare for that. I don't care what Dr. Fauci out in the US says that, we can contain it if we essentially, wear the mask or whatever. It's not going to work that way. However, what we're thinking is that it's not going to be a repeat of probably the total lockdown situation that we observed in 2020 or in the first half of 2021. And in the Malaysian context, there are limited risks. Risks are always out there, but the limited risk that we get to an MCO1 or MCO3 situation. We may get basically partial lockdowns around the world, but not lockdowns that are going to restrain economic activity. Economic agents like you and I, companies, policymakers, have adjusted to the state of the world where this transition from pandemic to endemic is not going to be smooth. It's not going to be short. It's going to be with us for some time, probably the whole of 2022, and I dare say potentially into 2023. That's built into our base case, being very realistic from that perspective. Not to shock you, but basically prepare for this eventualities, and we basically trade and invest accordingly. The good news is that around the world, on slide number 6, you'll see on the left-hand side, this is just what the data has been coming out on growth and inflation relative to what analyst predictions are. So this is called Economic and Inflation Surprise Index, put together by our esteemed colleagues at Citibank and available on Bloomberg. And you're seeing that across the world, economic data is surprising on the upside, and broadly speaking, inflation data is also surprising on the upside. If you put these two charts together, it basically tells you that we are in a synchronized recovery of the world, right? Despite all, and that synchronized recovery has been taking place pretty much on the growth front, since the third quarter of this year, as we exited the turbulent summer months in the world. And so we believe that this synchronized recovery, remember, this is now a synchronized recovery. Last year, and basically, the first half of this year and basic second half of last year was a US and to some extent Europe-centric story. Next year is going to be a global story, a global synchronized recovery across the US, Europe, and basically most of emerging markets. And from the China perspective, we're already seeing from our high frequency proprietary machine learning derived data for China, economic activity in China starting to stabilize. Here are our growth forecasts. So we just came out with our publication last night, I think it was around 10:30 at night. And essentially our views on, our GDP growth forecast for the United States is above the consensus, the Bloomberg consensus. We're at 4.3% next year and 3% in 2023. The Bloomberg consensus estimate is 3.9% and 2.5%. Basically, we are seeing pretty strong consumer spending in the United States. Capacity expansion of corporates is happening. And basically, the US economy remains flush with liquidity. And if you have this view on the US, you cannot be negative on the world unless you have some domestic shocks which are materializing. That basically is something that's always going to be there. In China, market has been downgrading GDP growth, right? People are now roughly around 8% for this year. Next year, they've downgraded to below 5.5%, which we think is trend growth. We're above market consensus on China, where we think that essentially the policymakers at the National People's Congress meeting in March, that's their big policy event, will essentially start guiding towards loosening of policy. Now, it's too early to tell what exactly they will do, but what we think is basically there will be some loosening of monetary policy. There will be some sector-specific loosening of policy as well. Like, for example, it could be property, it could be infrastructure, the usual suspects, and they're going to probably try to stabilize growth at around 5.5%. In the rest of the region, similarly, in Indonesia, we're above consensus. Malaysia, we're consensus. Singapore, we're consensus, aligned with consensus. Thailand, we are above consensus. So broadly speaking, across the world, we are somewhat more positive than the consensus. So what that means is that, if you take the example, if you think about dynamics of inflation, if you are more positive on growth, then you have to be more positive usually on inflation. So our estimates on inflation, if you look at the slide 10, we're fairly hawkish on inflation. As I mentioned, the supply side supply chain constraints will remain in place in the US and percolate to the rest of the world in 2022. And that will be above inflation prints in the United States for the next 2 years. We're at 4% in 2022 versus a consensus of 3.7, 2023 at 2.8 versus 2.3%. And essentially in home-based Malaysia, we're also above consensus estimate for next year. So what that means is that if you look at the dynamics of inflation, a lot of it, not a lot of it, but a substantial part of it is due to pickup in global food and oil prices. And and that is manifesting itself in partially why import prices in the US are on the way up. And you are also seeing that demand side pressures are picking up in the United States. And we think that this sort of inflation dynamics will spread to the world. So as growth and inflation were mainly a US EU centric story in 2021, it's going to spread to the rest of the world, including our home base continent, Asia, ex-Japan. The most important central bank in the world, the Fed, what are they going to do? So, after the November 4 Monetary Policy Committee meeting, we had come out with a note saying that the Fed was hawkish. When I looked at the press conference, 2 a.m., being a diligent analyst, I stayed up, listened to every single word that Chairman Powell mentioned, and we thought they were fairly hawkish. They're conversant with the idea that inflation is hard to forecast, that global supply chain bottlenecks are hard to forecast. However, growth remains fairly strong. If needed, they're ready to go. And what that means is ready to go is that the taper program that they've announced that will, be at $15 billion a month until December means that they could accelerate that pace if they felt that growth, inflation, employment conditions were coming in well above their forecast. And that's exactly what has happened over the last couple of days. Last 1 week has been, all of a sudden, the market's like, Chairman Powell's become even more hawkish. No, he's been hawkish since like November 4. You guys basically didn't get it. So what are we supposed to do with that? So that's why Chairman Powell said that, it's very important that we communicate properly. I thought he had communicated properly, but maybe because I have a PhD in economics, I read a lot into it. For the normal people, perhaps not. But bottom line is, the Fed is on taper for, is on track for a faster pace of taper. But in terms of the policy interest rate hike, the Fed funds rate, that's the policy rate in the United States, that progression, that hiking is going to be gradual. So the market currently, yesterday, was pricing in around 2 hikes in second half of next year, and to commence as early as the June FOMC meeting. So we're thinking that no, that's not, and more hikes in aggressive hikes in 2023. Our thought process is no, the Fed will be gradual. They will hike by 25 basis points in the second half, and potentially another 50 basis points in the first half of next year as inflationary pressures remain elevated. But we're not in a path of hiking where the Fed is going to hike like in previous Fed hiking cycles, I would say before the global financial crisis, the 2004 hiking cycle, every meeting 25 basis points. So they're not going to do that. And the reason why they're not going to do that is because the uncertainty on beyond 2022, what growth and inflation are going to look like in the US, as well as all the risk out there in the world. We have the China-related risk, we have the COVID-19 related risk, we have geopolitical risk in Middle East, and basically frictions in waterways here in Asia, where Western government trying to pressure China that, hey, don't basically encroach on anyone's territory. All those risks are out there. So they're going to be careful, because the Fed doesn't only look at domestic conditions in the US, but also has to be careful. It needs to look at what the global conditions around the world are. So that's good. So that's good for markets. So what that does for us is that the first big theme is when you start seeing financial markets starting to price in aggressive rate hikes. You need to think to yourself that what RHB mentioned today on a bright Saturday morning, that there is sunshine in the sense that the Fed ain't going to hike aggressively. They're going to be slow and gradual. Hence, the first big theme for investors: Fed hiking path, gradualistic. So if that is the case, how will that impact markets from a equity market perspective, from a bond market perspective? Do you want to hold cash? Why or why not? And the key message really is that the pace of what the Fed is going to be doing is basically reducing the pace of monetary accommodation. In plain English, what that means for markets is that we're not going to get a significant decline in liquidity in global markets. And that one measure of global liquidity, if you have to look at one measure as it correlates for asset prices, is in the left-hand side is global money supply index. So we're noticing that as we're starting to get a bit of loose reduction of monetary accommodation around the world, global money supply is starting to plateau. That's the blue line. However, you notice that the MSCI World Index, basically this is just a representation of global stock markets prices, has come off a bit, but it's not collapsing, right? And generally speaking, any stabilization in global money supply, unless you get a significant decline in liquidity and henceforth global money supply, is not bad for stock markets. However, on the right-hand side, if you look at the relationship between moderate declines in liquidity, as exemplified by stabilization of the global money supply index in blue line on the right-hand side, you are getting a significant impact in total returns of global investment grade bonds. Think about that as high quality bonds. It's as good as it gets. Even those high quality fixed income instruments are being hit, where the red line is showing you that since January, essentially as that slope of the global money supply index is coming down, the total returns on bonds, investment grade bonds, high quality bonds coming down. So what that means is the overweight in equities is warranted, even if the Fed is hiking gradually. And in bonds, you don't want to be there. You don't exit bonds in totality, right? You need that exposure to get some basically continuous coupon every month or every quarter, whatever type of bond you have invested in it. And so you're still getting the coupon, that's fine. You're holding it to maturity if you'd like. And you basically put it as a market weight in your portfolio. From the equity market perspective, what does it look like as we head into the first hike? So the Fed funds rate hike, slide 17, left-hand side chart, shows you the experience of the MSCI World Equity Index. How do global stock markets perform as we head into the first hike, which is on the horizontal axis given by 0M, which means 0 months. That's the timing of the first hike in each Fed hiking cycle. So last 3 hiking cycles, February 1994 was the start of a hiking cycle, followed by June 2004, another start of a Fed hiking cycle. And the most recent start of hiking cycle was December 2015. So the vertical line at 0 months is when those first hikes took place. And as we entered each of those first hikes, how did global equity market perform? Yes, as we're seeing the sell down now, the most severe was in the December 2015 hiking cycle, 13% decline, over the course of 9 months, because the sell down started 6 months prior and 3 months after the hike. But that was an exceptional period because we were coming out of the global financial crisis. We also had European risk out there, China hard landing risk in the summer of 2015 was there as well, and hence that's a very different period. So that doesn't apply, I think, to the current environment. What probably applies is, more to do with somewhere between the blue and the red line. So yeah, fine, we get 5% correction in global equity market. Not a big deal considering where we have come from. And so hence the overweight on equities is warranted even if the Fed is hiking, because it's going to be, the impact is going to be fairly temporary. And you see the bounce back across Fed hiking cycles, 3 months after, the market bounces. So as we're entering this first hike in the second half of the year, as the market's selling down, you're selectively buying equities. Where do you buy? The right-hand side, essentially the S&P 500 since January of 2010 has completely outperformed emerging market equities, right? So keep it simple. This trend, the trend is your friend, as we say in America. So continue to invest in the United States, avoid essentially emerging markets. There are some that you can invest in, and we'll get to that in a bit. And essentially, the picture in EM already is not looking good. If you look at slide 18, quite a bit of outflows. In the red line is EM bond flows, and essentially on the right-hand side is EM equity flows already starting to weaken as we're heading into this hiking cycle. The US, the place to be, the summary is given in slide 20. US large cap growth has outperformed US value. So stay in that trade. That has been the essentially trade since the end of the global financial crisis back in the day in 2009. And this has completely outperformed US value. Don't be cute. Continue to buy essentially, or essentially engage in adding to your portfolio on dips, the US large cap growth type of sectors. Equity risk premium on the left-hand side, just to let you know, market is starting to cheapen in the United States with the equity risk premium probably headed to 7%. It had been at 9%, the local peak as given by the blue line. And essentially as the equity risk premium corrects back to 7% will be the trigger for the S&P 500 to go on a secular uptrend. Alternatives, look at the flows into alternative assets. Whether you're looking at derivative products, you're looking at commodities, the flows picture has been pretty good this year, and the flows into alternative assets are going to be pretty good. I think commodities still flows to commodities type of products still going to be strong in terms of REITs, strong, real assets in property sector, strong. These are some of the places where in the alternative asset space, we are essentially advocating a overweight position. The second big theme is on supply chain disruptions. So I'd like to run you through a couple of slides to provide you the evidence rather than what you hear in the media. Right? We're analysts, so we should always basically focus on what is the evidence telling us and then convey it to you as our investors, rather than basically talk a big game that we heard this anecdotal evidence is fine, but if we have hard data, good to basically update you on what's going on in terms of supply chain disruptions. It will continue in 2002. It's US centric right now, but it will spread to the rest of the world. What that has done is that those supply chain disruptions have made it exceedingly difficult for central banks around the world to forecast inflation. So, given that most of the developed market central bankers, I think they went all went to the same graduate school and did their PhDs there, because basically they have the common language is, oh, inflation is transitory. Now all of a sudden, this past week, we had Chairman Powell say we're retiring the word transitory. Everybody was calling it forecasting that it's transitory. So he's like, it's not our fault, giving all kinds of excuses. It's nonsensical. They were just basically, in a tunnel vision, thinking that the structural drivers of inflation coming into this into COVID-19 would resume their path of keeping inflation suppressed without recognizing the supply chain issues are real. And the reason, one thing that is not talked about in terms of why we're getting to supply chain bottlenecks, right, is because demand is strong. Hey, look, if there's no demand from people like you and me for goods, why would the supply chains be congested in the first place? Because no one's buying anything. So the trucks and ships don't need to move. So the underlying premise that basically this is just a supply chain issue is nonsense. It's simply because demand in the US and other parts of the world is picking up, and those congestions are picking up as well. And that's the reason why you notice that the bond curves in the US and around the world, including Southeast Asia, are starting to flatten. What that means is that the market is starting to price in higher policy interest rates by central banks globally, and at the same time, essentially, we are recently seeing the long-term interest rates stabilize a bit. So the spread between 2-year bonds and 10-year bonds is basically compressing. It will continue to compress, and that will have ramifications for certain asset classes, which I'll talk about in a bit. So if you're a bond investor, what you want to do is play that flattening trade. And if you're an equity investor, flattening of basically bond curves, government bond curves, doesn't mean that you're selling bank stocks. The conventional wisdom is that steeper curves are good for bank stocks. It may not work in this cycle. There are other factors that may impact banking sector stocks. Flatter curves may or may not affect the trajectory of banking stock prices. And similarly, tech, people basically thinking that higher long-term interest rates is bad for tech. I don't think that's the case. Tech is going to continue to perform pretty well in 2022 in our assessment. So be careful in extrapolating what the implications of flatter curves are for essentially asset prices. These are just some of our forecasts, bottom line for 10-year bond yields across the United States and Southeast Asia. They're heading up, but they're heading up at a fairly gradual pace, which is again good for markets. Let me walk you through now the interesting part. I think this is probably the most interesting part of the presentation. I should just presented a couple of these slides and then exit it to Q&A. But this is the evidence on where we are in terms of supply chain bottlenecks in the United States. This data is as of the left-hand side chart is as of the 25th of November, and the right-hand side chart is as of the 2nd of December. It's as good as it gets, fairly real time. So US port container level index, what is that? That's the blue line, is showing you that containers are stacking up at US ports, whether it's in Los Angeles, whether it's basically on the East Coast, whether it's in Texas, you name it, the containers are stacking up. And the reason why they're stacking up is because you look at the inland container level index. These are the places, this is the red line. These are the locations between the ports and the logistics distribution center. They're basically running at low activity, low levels of activity, simply because there are not enough truck drivers, enough trucks to be transporting those goods from essentially the ports to inland destinations. That's one evidence of supply chain disruption is, improved a little bit as we head into the holiday season. Nothing conclusive yet, but it's still, as long as you see this gap, notice prior to COVID-19, when the port containers level index was going up, the US inland container level index was moving up with it commensurately. Statistically, there's a 70% correlation between the two. Now there isn't, because when the goods arrived at the port, they were immediately transported inland to these warehouses, and that's captured by the inland container level index. Now, the gap, as long as that gap stays, the supply chain constraints are going to be with us. The other interesting part is looking at what is the percentage of ports in the United States which have low activity. That's what the US port container low activity blue line on the right-hand side chart shows. It's showing you that 40% of the activity at US ports is low, meaning that those 40% of the ports in the US are completely congested. So the implication is it's bad. It's probably going to get worse, because I just talked about the dynamics of the US growth. But if you look at where the global and domestic output gap is, this is just a fancy word economists use to confuse everybody. All the global output gap, what an output gap is essentially where we are in terms of growth relative to trend growth, or let's say long-term average growth. So if the output gap is positive, it means that growth is running above trend. So the global output gap is already fairly positive, as exemplified by the blue line. And similarly in Asia, the output gap on the right-hand side, growth is also running above trend. And that is what is also pushing up the inflationary pressures, not only important for global CPI and Asia CPI, but it means that as the demand condition, as the recovery gathers pace in this part of the world, those supply chain bottlenecks will only get worse. They're not getting any better. So the key implication, if you're a stock market investor, is that the real, in terms of sectors, which are going to be having pretty good profit growth, are going to be transport sector, logistics sectors. Those are basically, in the real economy, the sectors which are going to be major beneficiaries of these supply chain bottlenecks. Let me skip a bit, and with basically this, flatter curves in the U.S., what we're likely to get is that dollar Asia continues to go up until the second quarter. In the second half of the year, Asian currencies start moderating against the dollar, simply because the growth differential between US and Asia would have narrowed, and that the market would have already fully priced in by the second quarter what is the path of future policy as far as the Fed goes, and we get a nice glide path in terms of Asian currencies appreciating against the dollar in the second half of next year. The last macro theme I'd like to discuss in the interest of time is China. So the key message is China, whether it's bonds, whether it's equities, is a sell-on rally, okay? And any related markets such as Singapore equity market or essentially North Asian equity markets are going to underperform next year. And our top country pick in Asia is India. So the left-hand side in bonds, India has completely outperformed China bond market since January 2010. And similarly, the stock market in India has also outperformed the Shanghai Shenzhen 300 index since January 2010 as well. So what is going to work for you? So India has a structural uptrend story, and China is on a declining trend structurally. That's going to happen. Every country faces that. There's no mystery. I don't see why investors, even until today, think that China is different, like they're from some different planet, that they can escape the trends that we've seen over 100 years, that basically economies have long waves of structural ascent and then essentially a decline for periods of time, and China is no different. Don't let anybody fool you on that front. And India for a long time had been on a structural decline. It's its time now, is on a long wave of an uptrend in terms of structural growth story. And that's the reason why you've noticed for a long time now, over the last decade or so, Indian stock and bond markets have continued to outperform, and they will continue to do so. Skipping to when we look at the relative vulnerabilities of shocks in China, whether it's essentially liquidity shocks related to credit events like Evergrande, debt issues in China, China slowdown risk, volatility picking up in Chinese capital markets, the least vulnerable, that's why we also picked India as a top pick in terms of financial markets in the region, least vulnerable India and Philippines. Most vulnerable are, of course, China, Singapore, Taiwan, Korea. We're avoiding those in 2022 in terms of the stock market. And basically, we would be neutral on Indonesia, Malaysia, and Thailand. So that's good for us here in home base, where we've completely underperformed this year in terms of equity market. There should be some catch-up play in 2022 for us. So let me just go through the key messages again. The bottom line is that we have a number of risks out there, and it's not time to panic. The sunshine is basically coming in 2022, and we would basically look to selectively buy assets on dips in global stock markets. We like the US, India, and in Southeast Asia, Malaysia, Indonesia, Thailand to some extent. In basically long-term interest rates, we are essentially thinking that rates are headed higher. In foreign exchange, the dollar remains strong until the second quarter of next year and starts moderating in the second half of next year. And hence, the global asset allocation in your portfolio is overweight equities, market weight fixed income, underweight cash. You're not getting anything for your cash return. And remember, in your overweight, do keep some alternative assets as part of that overweight. That's it from my side.
Thank you so much, Dr. Sailesh, for your very insightful sharing about the market outlook in 2022. I guess a lot of us have gained enormous value in the morning, so that is really a solid session. So if you have any questions for Dr. Sailesh, please write your question in the Q&A box, then we will address them accordingly. Okay. Of course, we are running a bit out of time, so we'll go through the Q&A fast. But if you are unable to address your question, please we'll just give an advance apology, all right? So the Kenneth would like to ask, the beginning of the end, right? Some street analysts coin this as the end of the bull as US slows and China crack down. So how do we prevent from catching the falling knife?
So the way to do it, when I'm saying buying the dip, you are essentially, when we invest in trade, we don't buy all at once. That's the idea, right? You are basically scaling into those positions, let's say in terms of the US stock market, in terms of India stock market, Malaysia, Indonesia, Thailand stock markets. Since the question is relegated to the US, the dynamics of Chinese stock market is not going to affect the US unless China is going to be in a hard landing. We're not basically saying it's going to be in a hard landing situation. So the US equity market is going to continue to do fine. It may not give you the same returns as what we've seen over the last couple of years, but it will continue to outperform the world.
Okay. Thank you so much for the answer. So the next question is by one Asmadi. So Dr. Sailesh, in your view, what is the likeliness of the impact, if any, of this foreseen tapering accelerating onto our capital market, especially Bursa equities market, especially in terms of major currency, especially US dollar inflow and outflow perspective in first and second quarter 2022?
Right. So the tapering, remember, is basically just a reduction of monetary accommodation. It's not tightening, okay? Just to clarify. And so the speeding up of the tapering is all it's saying is basically the extent of monetary accommodation just lessens. That's all. We're still getting essentially net liquidity injection by the Fed. We're just getting a little bit less of that. And that's not going to affect global money supply, global liquidity conditions. So the impact of this faster rate of taper is not going to have a profound impact on inflows into the Malaysian stock market. Would be my short answer. And keep in mind that basically all of 2021 has been a period exemplified by people being very negative on the Malaysian stock market, right? So all the bad news is priced in. Some strategists in the market are saying, oh, all the good news is priced in. Now, I'm not so sure how people come to that conclusion because the equity risk premium in Malaysia has come off very hard. So what that means is when the equity risk premium is very low, that is the time when the valuations are looking fairly attractive would be my short answer.
All right. Thank you so much, Dr. Sailesh. The next question is by Casey. So, Doctor, you seem to be very negative on China. Is it because of the recent regulatory clampdown, or you have other specific reasons? Could you advise us, please?
Yeah, that's a fantastic question. So the regulatory crackdown, from a sector perspective, it needs to be looked at very carefully. What is the intent? The intent of Xi Jinping and his close colleagues in the administration in China is to regain control of the economy and financial markets. They feel like, all these rich guys like Jack Ma and company, the Tencent guys, right? The property market developers, that they're in control of the economy. They don't like that, right? They're not really, as long as they feel that as long as they themselves, I'm sure that they're fairly well-off people, but they feel that if they lose control of the economy, it's essentially a risk to their control of power. It's a power game. Point number one. Okay, so they will continue to control the private sector, manage the private sector. It's not over. There will be other sectors that they will be imposing regulations on, and they've really shot themselves in the foot. But while we are, trying to tighten conditions in the tech sector in China, which is a very good sector, the new economy and all that. I like it. It's a fantastic story. But thanks to these guys, they are essentially, disrupting that ascent of the new economy in China. That's, I think, basically, on the way down now. The second aspect is that the developed countries' governments want to stop the ascent of China on the global in the world, right? Because the fact of the matter is the structural reforms in US and Europe over the last 20 years have been negligible. They haven't done anything, in terms of infrastructure, in terms of enhancing the education level and productivity of their people. I'm a US citizen, right? And I've lived in the US for a long time. Is that when you look at the educational system there, it's just not good. I'm not so sure whether they can even do math anymore. But the bottom line is they're worried that the capabilities of the people are so limited that we're going to be eaten up by this giant. This thing about the One Belt, One Road is a massive problem for these guys because it's big. It's not only traversing Asia, it's going to Africa, Middle East, and it'll be sitting at the doorsteps of Europe. So that dynamic is going to intensify. And one basically signal we're getting where the pressure from, let's say in the US as an example, on China is accelerating, is all of a sudden, President Biden comes out and says that, hey, Taiwan can do what it wants. So that's the second big thing. The third thing is the US, Europe, Australia, India are worried about the waterways here, navigational routes and strategic locations in South China Sea and Arabian Sea. That's a geopolitical angle. That's going to basically intensify as well. And we're already seeing productions being relocated from China to other parts of the world, including, good for us, we're a major beneficiary of essentially the production dislocation from China. We're getting the anecdotal evidence from companies looking for logistics, looking for warehouse, looking for factory production sites because they're moving the factory from China to Malaysia. I'm not saying it's in any big way, but it's the start of the end of the China business cycle. They're going to be in this long wave of structural decline. So all these guys like BlackRock, all these big swinging guys who are like, we're going to invest in, giving you a lot more China mutual funds and all that. Good luck to those guys, right? So the short answer is position for structural decline in China and structural ascent of India. That's the way to basically think about investing.
All right. Thank you so much for sharing your perspective about China. We actually already at 11:05, but we still see many good questions here on the Q&A. Dr. Sailesh, is it okay that we overrun it for a little bit?
Yeah, please just overrun it as much as you want. This is this session.
All right.
Intent is to clarify stuff, separate the noise from reality. That's what I like to call it.
That is cool. All right.
Okay.
Now, in view of the rising inflation rate in Malaysia, so which sector do you think will benefit?
So we have to be careful when we think about inflation, right? The inflation that we're seeing currently is a pure commodity price driven inflation. You know, I'm sure the person who asked the question looked at the last print on CPI inflation at 2.9%. We were at 2.8% for the October CPI inflation print. A lot of that has been so far supply side commodity price driven, mainly in transport sector, right? Nevertheless, you know, by the time we hit middle of next year, we will start getting more inflationary pressures in terms of core inflation, which basically removes the food and oil price effects on inflation. How do you invest in Malaysia from this perspective, right? The sectors which basically I think are going to look fairly solid are the E&E sector, right? I'm a big believer that this tech cycle is you know, and I'm not the type of person who's like a Warren Buffett guy. I look at things in 5-10 years, don't care. Basically over the next year or 2 years, a maximum like 2 years. But next year, basically, tech sector globally is going to look pretty good, right? We get basically periods of sell down in NASDAQ and some weakness here in the tech sector in Malaysia. But that's the place where I think we're going to get pretty good returns. Other sectors which are major beneficiaries of the pickup in inflation are, as I mentioned, supply chain bottlenecks going to intensify even here in Malaysia as the economy, hopefully, you know, this Omicron event risk dissipates in first quarter, hopefully, but abstaining from that impact, basically logistics, transport companies here in Malaysia are going to be benefiting major, right? Because they're going to have a lot more pricing power going forward. And of course, essentially commodity-related sectors are also likely to be doing well over here. You know, I think that oil prices, you know, the collapse in the December contract of Brent oil futures, which obviously affects oil prices over here, is way overdone. I think the trend for oil food is strong. So commodity-related, counters-related oil and essentially food are also opportunities in this market to look at very carefully.
All right, thank you so much. Now, what do you think about glove sectors? Do you think that it will rebound due to Omicron emergence concern? So this question by Javid.
Yeah, so the trouble with the glove sector here, as you know, has been more of governance risks. So there's kind of a correlation breakdown, and I'm not going to talk about in any detail what I mean by governance, because all governance, you all know what that means. Okay, those risks are there. You know, and how they kind of stack up with the benefits of, you know, in terms of revenue generated from selling gloves is a big unknown. So for me, I got much better places to invest my money. Like I said, you know, in terms of thinking about the tech sector over here, transport, logistics, commodity-related, agro-related sectors, that's what I would prefer to be. Like I say, I like to keep it simple. Areas where we have a clear vision is the place to be. Gloves is basically a lot of, you know, complications, too complicated for me to comment on. I would just say it's not, you know, something that I would look at carefully.
All right. Dr. Silas, you were quite bullish on India, right? So the question here is how a Malaysian can tap into the potential of India through what instrument?
Well, you could always basically go to your you know, salesperson or RM and just buy, because, you know, India is also not a uncomplicated market. It is complex, you know, and basically it behaves very differently because the forces at certain points of time, because the forces of domestic liquidity, you know, so far, the reason why the Indian market has been going up is not because of foreign capital inflows, for your information. is because of domestic buying. So the simplest way, in the interest of time, is essentially go to your RM and buy, look at an India ETF. A large cap India ETF is the simplest way of expressing the view for a Malaysian investor, or essentially India dedicated mutual fund. That's how I would do it.
All right. Thank you so much, Dr. Sailesh. So maybe we'll just do one last question.
Okay.
So I think I just summarize some similar questions here. So what is your view in terms of the US debt consolidation, which has been concerned for a while? Do you see that the bond bubble will burst anytime soon?
No, because I think what will happen is that bonds are not the favorite investment destination in the first place, nor are they the worst. And the reason is that what we're thinking in terms of bond yields in the US and here in Southeast Asia, including MGS, right? We have a view that MGS 10-year yields, by the end of next year, maybe we essentially hit around 3.94% roughly, about 30-40 basis point move from here. We are at 3.6%, right? Which is not a big move over the course of a year, by the way. So we're just waiting for that progression to pick up. And so we're avoiding investing in essentially long-dated government bonds. Since we have the market weight in fixed income, it means we obviously must be investing something in fixed income, right? So we will be essentially investing in medium-term bonds in government bond market over here, as well as essentially some of the corporate credit, things like in the power and the commodities, infrastructure, to name a few. That's how I would play them. So there's the bond bubble. It's not, I wouldn't say it's broken, nor would I say we're in a bull market. Hence the market weight on fixed income in our global asset allocation.
All right. So thank you so much, Dr. Sailesh, for sharing with us your view about the global market. And so that's it, guys. So this is Dr. Sailesh Keja, the Group Chief Economist and Head of Markets Research from RHB Investment Bank. So hope that you gain a lot from today's webinar session. So for more information and more opportunities in this kind of webinars, you can visit Bursa Marketplace for more these webinars organized by Bursa Malaysia for all these brokers and also public listed companies. So have a great rest of the weekend, people. So yeah, thank you so much, Dr. Sailesh, for tuning into this webinar, share with us your insight. All right.
Thank you, everybody, for giving us your time on a lovely Saturday morning. So hopefully you go to Penang or Genting today, but see you next time. Thank you.
All right, cool. So for those of you who have not had an RHB trading account, you may write your name, your mobile number, and also your town and the city in the Q&A box. Then RHB will arrange a friendly dealer representative attend to your account opening request. So if you open a stock trading account through this webinar, you will be waived the CDS account opening fee, and you're the first, if you're first 100 women investors who open a CDS account during this campaign period from 11 November until 31st of January 2022, then you will be credited with a 50 ringgit cash voucher from Touch and Go into your e-wallet. So with that, thank you, everybody. Have an enjoyable weekend.